Hello, good afternoon. You've tuned into MF Corner on CNBC-TV18. I'm Vinnii Motiwala. Thank you so much for tuning in, as always. Now, this episode, what are we going to be focusing on? We're going to be putting the spotlight on common factors that investors tend to overlook while investing in mutual funds. Too many schemes of a particular category is one such example. You have over-diversification. That is another thing that could maybe eat into your returns as well. So, how are you going to declutter your portfolio? What is important? You can't just keep adding, right? So how are you going to get some things off the plate as well? That's important in a portfolio. To talk to us about all of that, we have Kalpesh Ashar, CFP, RIA of a Full Circle Financial Planners and Advisors joining in with us. Kalpesh, good afternoon and thank you so much for joining in with us on the show. You know, Kalpesh, we've always spoken about what I should buy, what I should look at, how many SIPs. Now tell me, when is my time that I look at it, oh my God, I have over-diversified, I have too much in my portfolio. What are the signs that one should watch out for this situation?
Thanks, Vinnii, for having me here. And this topic, is not always spoken about. Because like what you rightly said, we always talk about returns, we always talk about the ups and downs in the mutual fund portfolio or markets per se. But nobody talks about how much is enough. And in mutual funds per se, like many other things in life, what people think is that larger the better. Whereas, like after a lot of evolving stages of life, people understand that less is more. So that also needs to be somewhere brought down to your mutual fund portfolios, and that's what we are going to talk about. That how do you declutter a portfolio? Because in our daily practice, we see so many, portfolios having numerous schemes, and ultimately it's nothing but just overlapping of the same schemes with different AMCs, or the categories which are there, they just keep repeating. Because, what has happened is that it's a great boon that the mutual fund, I would say the revolution has taken off in India. But now it's a stage where it needs a little bit of introspection, and people need to understand that what is actually required to make a healthy mutual fund portfolio. So if you see mutual fund portfolios, you will find people having one AMC ka many schemes. Yeah. Because probably that's a bias. They have a certain confidence with a certain AMC.
With some AMC. Sometimes you're like, I might as well buy one more of this one from the same.
But they stick to the same AMC. That also is a bit of a risk, because you want, again, a diversification in the people who are handling your money as well. Then you have too much of a particular category. So you will find portfolios having so many, say, mid caps, so many small caps, so many large caps. Now, again, that is a bias because they have not been advised properly. And more so, it's been the flavor of the season. But let me tell you here that mutual funds is not your, ice creams or flavor of the season that it comes and goes. And like the typical question people ask, what is good nowadays? Yeah. Mutual fund is not what is good nowadays, what is good over
a period
years.
Of time. Yeah.
So people need to understand that. Now, all these points put together, plus I think we'll discuss during the course of this, make a portfolio very, very lethargic and flabby, if you would put it in health terms.
So I have to make it fit right now as well.
Absolutely.
So, Kalpesh, before we dive into how to get fitter in terms of your portfolio, what are the major issues, other than some of them you have highlighted, right? Going into just one form of an AMC, or maybe just going into large caps and just looking at that particular side. Major issues that are there in terms of a portfolio that is over-cluttered, as well as in terms of common risks that an investor makes when they're trying to declutter.
So first and foremost, let's find out the reasons why people do this in the first place. And most of it now we're exposed to the digital world, and on the phone you get everything, and print media is there, digital media is there. People look at the star ratings. And they go, which is the latest one, which has performed in the last 3 months, 6 months, and the number of more the stars, the better the fund. Now, that's a myth, because over the years, if people have studied mutual funds, that there is no particular performing fund which repeats itself more than 1 or 2 years. And then when that star falls off, it goes down the barrel of that mutual fund portfolio, and the people even don't look at that. So they're looking at that star rating. Obviously, performance, returns are paramount. But that's not the only way you choose a fund. And people are susceptible to it. They keep making that same mistake. Second aspect which is there is, that without blaming any AMCs, because that's their business, NFOs keep coming.
Yeah.
Okay. And more the NFOs, people are more attracted to it, probably saying that Naya kya hai?
Yeah.
And what's new. And more of it, if they think they're technically sound, they are probably, I would say, not aware of the fact that they are just adding the same thing, that's like the old wine in new bottle, into their portfolio. Because there's nothing novel coming out very frequently. Obviously, there are very good themes which AMCs come out, they manufacture, they see what is required, but not everything is novel. Other thing is they are under the myth that when they buy a mutual fund, it's bought at 10 rupees. So that 10 rupee, bait of the NFO, draws a lot of people into this, and they just keep accumulating NFOs over NFOs, and then really they don't track also. Okay, so that's another problem. Now the thing is that this NFO frenzy is one part. The second thing is, which we just discussed in the previous point, is that they see what is the momentum going on right now. And they do not look at what is right for them. They look at what is going on right in the performance.
Everyone wants to enter in as that FOMO fad. Yeah, I don't want to miss out on anything.
FOMO is the word. FOMO is the word. But what you need here is a focus on your portfolio which is aligned to meet your long-term and short-term goals. Now, in the frenzy of trimming your portfolio, like what you say, that they say, oh, I've got too many things and it's overwhelming and I need to come out of it. They do it in a hurry. Okay. Many a times, if they feel that they can't even look at the type of returns which are generated, or they're not given enough time to it, they exit. Now, obviously, there's a capital gain tax element to it. So even if they have not completed 1 year, they come out of it, they entail a short-term capital gain on that. Second, they invite exit loads on each and every fund.
So that again is a cost that you're
That again is a cost, and you've taken that decision in a hurry without really putting your mind to it. And all because of one important thing, that their portfolio was not structured to meet their financial goals.
Is there a difference that it makes in terms of, there are so many options now, right, for me adding into mutual funds. So while decluttering a portfolio also, how important is it? Like sometimes you can directly go on the sites and get into mutual funds. There is demat accounts now as an option as well. How important are such different methods? And does it make a difference when I'm decluttering my portfolio?
So the idea should be, or the focus should be, that what you do, keep following it. Don't go like, there is an option available that you can do your mutual funds through demat. Now, nothing wrong in it, but there are certain shortfalls that in the demat format, what you're doing is actually you are only buying or selling through the units part and not the amount. So certain things like the excellent features which are there in a mutual fund, which is you can do an STP or an SWP, becomes very cumbersome if it's done through the demat account. And the physical mode of the mutual funds, which is we all do the offline mode, is more easy and I think more manageable. But the point what I'm trying to make here is that if you follow a certain pattern, now don't say that I've got mutual funds in my demat account. I've got mutual funds in a normal physical mode. I also do direct plans. I also do regular plans. So
that's going to be difficult for me to handle.
Because that is what they're hearing. That's now you should do this, now you should do that. And if you don't have the assistance of a proper advisor or a distributor, I think you're going to go haywire. And that's what we have seen many portfolios. Now they listen to certain people. Now they start and stop SIPs at their own will. Now SIP is not to be done or managed that way. We've spoken enough. This is not the forum to speak about SIPs. But everybody knows what SIPs are. So they start and stop SIPs at their own whims and fancies, and that portfolio again is left hanging. So the point what I'm trying to make is, whatever a person is doing, get a proper advice and follow that. Because that becomes of paramount importance, that he develops a healthy and a trim portfolio.
Absolutely. Healthy and a trim portfolio is what is required. But how will I get to it? What are the steps that one has to take to get to that trim portfolio? What are the practical steps one should follow, not what people here say and do?
So, one more thing before we go into that, I'd like to point out is the problem of, making sporadic decisions and getting into new things. People also make this decision from their various bank accounts which they have. So if they have assigned, for example, certain mutual funds in a certain platform through a certain bank account which they're going to make and redeem and get the money there. They also do it simultaneously from their another 2-3 bank accounts. But the problem is, in some frame of mind, if they've shut that bank account in which they've invested, and again it's a basket of schemes they've invested, they do not really know that that bank account has been assigned to a particular mutual fund. And when they want a redemption, they are stuck. They have to undergo the whole process of a change of bank, and the redemption time then lapses. So this is the practical thing. Now, how do you focus on making a trim and a healthy portfolio? I think first and foremost, let's get back to the basics, which is identifying the purpose of your investment.
Okay.
Once the purpose is identified, the risk tolerance is decided, and your cash flow, which is the starting point of from where are you going to make the investments, those three things are streamlined. I think you'll be more focused on creating a healthy portfolio. Second is, do not get swayed by all the noise of new things happening around you. Because if you are stuck to a particular path by a particular advisor, it's better to tread that, because there's a lot of thought and a lot of technical advice which is associated with that, why you're in this particular schemes or particular funds. So it's similar to, you might go to a mall every Sunday, but not necessarily you will be buying every Sunday. You can just go for enjoyment, have a look around, and then come back.
Just window shopping.
Just window shopping. So same is with mutual funds, that once you've got what you have in your portfolio, unless and until, basically if you're doing really well and you want to add on to certain things,
then it's
add amounts. So that is more important. And only if there is a scheme which requires that type of a, I would say, direction for your goal, then go to that new scheme. So we can highlight it, what types of schemes are required, to each his own.
Absolutely. On that note, actually, we're going to sip into a very short break. We'll continue this conversation with Kalpesh after the break as well, so don't go anywhere. Welcome back to Mutual Fund Corner on CNBC-TV18. Today we are discussing how you should declutter your portfolio. You have added too many mutual funds in your portfolio. Kalpesh is here to help us with that. We've gone through a whole host of details. But Kalpesh, while we've spoken about, how they should be looking at getting out of it, having a larger portfolio is a myth. We've spoken about all of that. But tell me, what is the ideal way of a portfolio? What is the ideal allocation in terms of a portfolio? What is the maximum amount of number of portfolios I should have? Large cap, mid cap, small cap, how much should that be in my portfolio?
So, there's no thumb rule for this, Vinnii, but through experience, what we found that what would be the ideal mix. Now, obviously 10-15% up and down is fine, but the ideal mix, because, now post 2018, when SEBI has categorized mutual funds into so many things, there's a host of people lined up to say, "Mereko ye bhi chahiye, I want that, and I have to be a part of this." It boils down to simply that you could have a max of 6 to 8 or max 9 funds, schemes, I would say, in your portfolio. And I'll just highlight that how we are looking at. So if from a personal financial planning perspective, because that's what I do day in, day out, I would say you can have 2 debt funds. Let's start with debt funds. The simple reason is that you could have one debt fund, which is a liquid fund, assigned for your emergency needs, a contingency fund, which is easily in and out, and there's no qualms on that. The second one in the debt fund category could be either a corporate bond fund or a banking PSU fund or a short-term fund, because that is a little bit less volatile than the than the government securities which are there. And that could serve as your, medium-term goal, or it could serve as a hedge to your portfolio, and it does that job. So 2 funds in the debt space are good enough. Now coming to the cream, the equity part of it, In the equity part, I think now there's a lot of passive investments which are picking up, and, all those things. You could have 2 large cap funds, because that is where people would want a little bit of more presence. Most of them, I'm not saying that each one of them. So you could have one index fund, and you could have one active blue chip fund. So a large cap fund, which we call. So that's 2 more there. You could then have a couple of flexi cap, because flexi cap, I believe, is a category where you are completely depending on the fund manager to have his say. He's not bound by anything, and he can swing across according to his discretion. So one, you could have a flexi cap fund, which probably is a little bit more dynamic by nature, and also has the liberty to invest, say, for geographical diversification, say in international stocks, and one which is a conventional flexi cap. So you have another 2 there. And finally, for the alpha, which everyone wants,
That's what everyone's waiting for.
Okay, so that sweetness, that mithai, which people want, is 1 mid cap and 1 small cap.
Okay.
So that could there, because excess of mithai also is dangerous. So
that's true. Diabetes is not what we want.
Not what we want. Okay, so we want controlled. Yeah, we want controlled growth. So mid and small does the job for that. So 1 or 2 or maximum, because it's a little bit of a volatile area, you could have 2 mid caps and 1 small cap, or vice versa of that. That does it. I think you should not really be more than that into anything. Now, unless your advisor suggests something or you have the bandwidth, maximum, I would say, you could take the liberty of 5 to 10% in a sectoral fund.
Okay.
So that is what could be permitted, but again, don't overdo it, because that is where we have seen in the last 2 years, people have been completely...
And then now
and now they've seen what the color of that is,
True.
So that is what could be an ideal mix of a decent trim portfolio.
Okay, 2 debt funds, 6 equity funds, and in that also Kalpesh has mentioned where you can look at in terms of large cap, flexi cap, index funds. What's the breakup there? He's spoken about that. So that's interesting, and thanks so much for that, because it makes it easier for all of us. But how often do I need to, maybe review or rebalance my portfolio in terms to get the right asset allocation? Should I do it yearly, 2 times a year? What is the right way so that I know that I'm not over-added, I've not done anything wrong?
So 2 ways to do it. One is surely looking at the time duration of your financial goals. Okay. So because each and every investment is tagged towards a financial goal. So as and when the financial goals are, approaching, you make the necessary changes. And apart from that, on a technical basis, I would suggest that it's not a fill it, shut it, forget it product, as people still think, but you need to review it, I think, once a quarter. So that would be ideal.
Okay. Kalpesh, sometimes I've heard people say that, okay, maybe I'm adding multiple funds that will give me better value. Does that make sense, or is that just a myth?
No, I think that's a myth, because, it dilutes the returns. If you see on an overall portfolio, because let's understand, Vinnii, what are mutual funds? Mutual funds by nature offer you diversification, right? Yeah. Now, even if one scheme, if you take in a large cap or anything, you're automatically exposed to 30 to 50 stocks. Now, in that, you keep multiplying, you say you have 8 portfolios, and if they're different by nature, you will still have 70 to 80% of overlap in that, and the remaining will be novel. But beyond that, I think it's just a simple case of dilution.
And Kalpesh, is there a way that, how long should an investor actually wait before exiting? So I'm looking to declutter, but there are times that your mutual fund, one of your mutual funds or something in your portfolio is underperforming. How long should I wait before judging whether I should actually get that one out of my portfolio, or what is the strategy there that I should follow?
One of the parameters of evaluating it is at least give it, I would say, 2 years. 1 or 2 years, because here we are not going by the mutual fund thing, we are going by an economic cycle rotation. That anything would probably, have that much 8 quarters type of a time frame for it to perform or underperform. And then I think you could look at it for either keeping it or redeeming it. Other thing is that what we said, on the face of it, to the naked eye, if there's too much of one, I think you don't need any time to say that I need to trim.
Absolutely, too much of fun, then you know what you should be trimming as well, removing your carbs or removing excess sugar.
Absolutely.
That's what you should be looking at. Kalpesh, to round this whole conversation up, I know you are a movie buff, you give us interesting analogies over there. So something to round it up and making it fun for our viewers in that terms.
Oh, great. So, what I would suggest is that when you have a mutual fund portfolio, you add amounts to it and not schemes. And that brings me to a very famous dialogue from the evergreen movie Anand, which Rajesh Khanna was saying that zindagi badi honi chahiye, lambi nahi. Similarly, आपका portfolio बड़ा होना चाहिए, लंबा नहीं.
Absolutely. So bigger in terms of amount, not the amount of longer, but not the amount of portfolios that you have. So keep it simple, keep it small. I think you were saying that also before in the conversation. That is what we're going to be doing. And to round it up, one liquid scheme is what we should have as a contingent fund in terms of debt. We should have a short-term bond fund as well is what one should watch out for. 2 large cap funds, could be between index fund and large cap funds. Then you can look at 2 more flexi cap funds, something in a mid and small cap is something. And sector thematic?
Only if required.
Only if required is what one should be maintaining. So thank you so much, Kalpesh, for joining in with us, helping us understand also in terms of how one should follow in terms of decluttering the portfolio, the steps that we should follow as well. So thank you so much for joining in with us, coming to the studios as well, and helping our viewers understand all of that. And viewers, thank you so much for tuning in as always. Hope this helped you all declutter your portfolio, making it fit from the flap situation if you're going through that. So thank you so much for that. But don't go anywhere. Up next, we have Closing Bell to take you through the last hour of trade.